It has been proven that real estate builds wealth. Many millionaires or even billionaires these days have built massive amounts of wealth by investing in real estate. You can own the underlying properties directly, or you can invest in real estate in an indirect method by owning REITs, or real estate investment trusts. And in today's video, we're going to take a look at 7 of my favorite REITs, touch a little bit on why I like each of them, what is their current state, what has been their past performance, and what do analysts believe these REITs are going to do over the next 12 months. So with that being said, if you could do me a huge favor and smash that like button down below, subscribe to the channel as it really helps us spread the word and grow our channel. And with that being said, let's jump into the video. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we jump into today's video, let me take a moment to thank today's video sponsor, which is Aura. This day and age, we hear about data breaches almost on a weekly or monthly basis, proving to leave much of our personal information exposed for cyber criminals all over the world. This is where Aura comes into play to protect your data. Data brokers are making fortunes selling that information to scammers looking to learn more about you, and Aura can help. Aura can identify data brokers exposing your information and submit opt-out requests on your behalf. Brokers are legally required to remove your info, but they make it difficult to do so. That is where you can let Aura do it for you. Aura offers a number of different offerings for its customers, including credit monitoring, password management, VPN, antivirus, and a number of other things. The best part is you can try all of their offerings completely free just by using my link down in the description below. So make sure you give Aura a try today. Now back to our video, taking a look at 7 of my favorite REITs. Now to begin, a REIT is a real estate corporation that owns income-producing real estate, and they derive at least 75% of their income from real estate-related activities. I have covered the basics of REITs in other videos, so make sure you check out those on the channel as well. And now let's jump into my 7 favorite REITs. And again, this is not a buy now list. This is just going through 7 of the favorite REITs that I like, not 7 that I will buy right this instant. But we're going to take a look. We're going to quickly go through each of these 7 REITs, take a look at their past performance on a 12-month basis, year to date. We're going to look at what analysts are expecting for 2023 and over the next 12 months as well. So we're quickly going to go through each of these 7 REITs. And again, we're not going to fully break down each REIT, but if you do want a breakdown video, let me know down in the comments section below. Let's begin with REIT number 1, which is Realty Income, stock ticker O. You can't do a REIT video these days and not mention Realty Income. After all, they're probably the most well-known REIT on the market, and they coined themselves the monthly dividend company. The REIT has a market cap of $42 billion. Over the past 12 months, the stock is down 18%, and year to date, the stock is down 7%. REITs in the real estate sector has been underperforming for the past 12 to 18 months as we have gone through this period of rising interest rates. Due to the structure of a REIT, they tend to have higher amount of debt. And with higher interest rates and high debt, the cost of debt just goes up, which is a negative for real estate owners. So although the sector has underperformed, it's not the case for all of those REITs. And you're going to see some REITs that have actually outperformed over the past 12 months as well. When it comes to Realty Income, they are a retail REIT with over 13,000 real estate properties and a high focus on investment-grade tenants, with roughly 40% earning an investment-grade rating. Here's a look at some of those high-quality tenants, which include Dollar General, Walgreens, FedEx, CVS, Walmart, Tractor Supply, and Lowe's companies. The portfolio as a whole is well insulated from a recession, as the top 3 industry sectors include convenience stores, grocery stores, and dollar stores. As I mentioned at the start, Realty Income pays a monthly dividend. They have a dividend per share of $3.07, which equates to a dividend yield of 5.2%. The company has low 5-year dividend growth rate of 3%, but they have been hiking their dividend for 29 consecutive years and counting, making them one of only 3 REITs on the prestigious Dividend Aristocrat list. When it comes to analyzing REITs, you don't want to focus on earnings per share or EPS. Instead, we look at FFO or AFFO, which is adjusted funds from operation. The reason being is that EPS takes into account depreciation expense. And when you have real estate, there's a lot of depreciation expense that hits the books. But after all, as we know, real estate is often an appreciating asset. Analysts are calling for 2023 AFFO of $4 flat, which equates to an AFFO multiple of 14.8 times for Realty income. For comparable purposes, over the past 5 years, shares of O have traded at an average multiple of 19.4 times, so a big gap there. In terms of analyst expectations, they have a 12-month price target of nearly $72 for the stock, which implies 21% upside from current levels. Now moving on to REIT number 2, which is VICI Properties, stock ticker VICI. VICI Properties is the largest REIT that I own in my portfolio. And if you're ever interested in seeing my entire dividend portfolio, then consider subscribing to my Dividend Investors Edge newsletter, which you can find at thedividendinvestorsedge.com. And when you subscribe there, you get my monthly dividend portfolio update, which includes all my buys and sells in the month, looking at the portfolio performance, and also looking at my dividend income. A subscription also includes 2 individual deep dives, which could be a REIT or another dividend stock, as well as our valuation dashboard. Now turning our attention back to VICI, which is a casino and hospitality REIT, and again, the largest landlord on the Las Vegas Strip. The company has a market cap of $31 billion, and over the past 12 months, the stock is down 9%. Year to date, though, they are down only 2%. The REIT has quality assets along the Las Vegas Strip, such as Caesars Palace, MGM Grand, Park MGM, Mandalay Bay, New York, Luxor, the Mirage, and many more. VICI has been a public company for only a handful of years, going public back in 2018. And with all of these great properties, they work with some of the best operators in the world today, specifically in the hospitality and casino sector. The company enters into very long-term master leases with these operators, 20-plus year leases we're talking about. VICI currently has a portfolio of 50 properties, one that has grown every single year. In terms of the dividend, VICI currently pays a dividend per share of $1.56, which yields 5% flat. Over the past 5 years, they have a 5-year dividend growth rate of 8%, increasing the dividend each and every year since going public. Analysts are calling for 2023 AFFO of $2.13 per share, which equates to an AFFO multiple of 14.6 times. For comparable purposes, over the past 5 years, shares of VICI have traded at an average multiple of 16.3 times. Analysts have an average 12-month price target of $36.50 per share for VICI, implying 18% upside from current levels. Now moving on to REIT number 3, which is Prologis, stock ticker PLD. Prologis is a major play on e-commerce and the growth of e-commerce, as Prologis is the largest warehouse and industrial REIT on the market today. The company has a market cap of $115 billion. Over the past 12 months, the stock is down 6.5%, but year to date, they are up 8%. Prologis is banking on the growth of e-commerce and the penetration that e-commerce will continue to become more of the retail sales component. In fact, e-commerce is expected to increase by an average of 1 percentage point per year over the next 5 years, accounting for more than 30% of all retail sales by then. Prologis has some high-quality tenants, beginning with the largest e-commerce retailer in the world today, which is Amazon. They are then followed by the likes of the Home Depot as well as FedEx. In terms of the dividend, Prologis pays a dividend per share of $3.48, which yields 2.8%. Over the past 5 years, we've seen dividend growth rate of 12.6%. So you're getting a little bit lower yield than the others we've seen so far, but faster dividend growth. In fact, the company has increased the dividend for 10 consecutive years and counting. Analysts are calling for 2023 AFFO of $4.68 per share, which equates to a price to AFFO multiple of 26 times. For comparable purposes, over the past 5 years, shares have traded at 27.5 times. So not as big of a gap as we've seen with the other REITs so far, but still undervalued. Analysts have a 12-month price target of $145.36 per share for shares of PLD, implying nearly 20% upside from current levels. Moving on to REIT number 4, which is Simon Property Group, stock ticker SPG. For those of you unaware, Simon Property Group is the premier mall landlord in the world today. The company has a market cap of $44 billion. Over the past 12 months, the stock is up 12%, and year to date, it is roughly flat, up only 1%. Simon Property Group has flipped the script, being the first REIT on our list to generate a positive return over the past 12 months. I often hear the saying, malls are a dying breed. No, C-rated and D-rated malls are a dying breed. Simon Property Group is not a dying breed. How they classify malls these days is based on the retail's sales per square foot. So how are the tenants doing in your malls? Well, when you look at the portfolio of Simon Property Group, they have an A-rated portfolio. Put another way, this rating or reclassification is solely based on results driven by the tenants. So if your tenants are selling, that's both good for the tenants as well as Simon Property Group. Looking at the dividend, Simon Property Group currently pays a dividend of $7.60 per share, which equates to a high dividend yield of 6.4%. The REIT did have to cut their dividend during the pandemic, but have quickly increased it back up with increases of 6%, 9%, and 27% in the past 3 years. Analysts are calling for 2023 AFFO of $10.83 per share, which equates to an AFFO multiple of 10.9 times. For comparable purposes, over the past 5 years, shares of SPG have traded at an average multiple of 13 times. Analysts have a 12-month price target on shares of SPG of $127.70, implying 8% upside from current levels, which makes sense given the run we have seen over the past 12 months. REIT number 5 on our list is Agree Realty, stock ticker ADC. Agree Realty is a much smaller version than Realty Income, but up and coming nonetheless. And if you haven't heard of Agree Realty, definitely have this REIT high on your watch list. The REIT currently has a market cap of just $6.2 billion. Over the past 12 months, the stock is down 15%, and year to date, they are down 8%. As you can see, the stock has traded in lockstep with Realty Income over the past year and for much of 2023 as well. The chart's looking almost identical. Like Realty Income, Agree Realty also has a major focus on high-quality tenants. Actually, a much higher focus, with 60% of their tenants being investment grade. Some of those top tenants include Walmart, Dollar General, and Tractor Supply. Many names you see on Realty Income's top tenant list as well. One of the main difference really comes down to exposure of some of these top tenants. Now, Realty Income is a much larger. They have over 13,000 properties, so a lot more that can be spread out amongst different tenants. Agree Realty, though, being much smaller in terms of size, the exposure weighting is going to be a lot higher for them. When you look at their top tenant, which is Walmart, they have a exposure rating of 6.5%, which again, Walmart is a great company, a high quality company, so there could be a lot worse things there to look at. In terms of the dividend, the company has a dividend of $2.88 per share, which equates to a dividend yield of 4.5%. They have a 5-year dividend growth rate of 7%, and they have increased their dividend for 10 consecutive years and counting. Analysts are calling for 2023 AFFO of $3.95 per share, almost identical to the $4 flat of Realty Income, but that equates to a multiple of 16.4 times. Over the past 5 years, shares of ADC have traded at an average multiple of 20 times. Analysts have an average 12-month price target of $75 for the stock, implying 16% upside from current levels. REIT number 6 on our list today is WP Carey, stock ticker WPC. WP Carey is a diversified REIT with over 50% of their annual base rent coming from the industrial and warehouse space. The REIT currently has a market cap of $14.2 billion, and over the past year, the stock is down 21%. Year to date, they are down 15%. The stock has just been under heavy pressure in 2023, and more recently as they reported Q2 earnings that saw the stock fall even further after revising their 2023 guidance. Like Prologis, WPC is a play on e-commerce, as e-commerce continues to penetrate into retail sales and account for more of the overall pot. That will benefit a company like WPC. But again, they're much more diversified than Prologis. They used to actually have a lot of exposure to office, but they started changing their game plan well before the pandemic hit, and man, was that great timing. The other unique thing about WP Carey is the fact that over 50%, in fact 54% of their leases are linked to CPI or inflation. So this is an inflation hedge, especially during times of high inflation like we've seen. It can be a major tailwind for the company moving forward. In terms of the dividend, the company pays an annual dividend of $4.28 per share, which equates to a high dividend yield of 6.4%. Although they have a high yield, the dividend growth has been quite minute, but the company has increased the dividend for 25 consecutive years and counting. Analysts are looking for a FFO of $5.37 per share in 2023, which equates to a multiple of 12.4 times. This compares very favorably to their 5-year average of just 15.2 times. So quite the gap there, making shares look undervalued. Analysts also tend to agree as they have an average 12-month price target of nearly $80, implying 20% upside for WPC over the next year. REIT number 7 and the final REIT on our list today is American Tower, stock ticker AMT. The communication sector, especially this REIT, has been under intense pressure in 2023, not just due to higher interest rates. American Tower has a market cap of $86 billion, and here it is. Over the past 12 months, the stock is down over 30%, and year to date, it's not much better as it is down 14%. American Tower builds and owns cell towers across the nation today, or across the world, I should say. And those spots are then leased out. Those towers are leased out to the likes of AT&T, Verizon, T-Mobile, and many others. This keeps the legacy telecom providers from adding even more debt to add all of these cell towers. And the other great thing about American Tower is they don't have to worry about the big battles for customer acquisition between the major 3 telecom providers. This infrastructure that American Tower has built out and continues to build out is imperative in today's modern world. The company pays a dividend of $6.28 per share, and they have a dividend yield of 3.4%. But where the unique thing is REITs, you don't see it all that often, but you saw it with Prologis and you also see it with American Tower, is dividend growth. The company has a 5-year dividend growth rate of 13.3%. So you're getting a decent yield at 3 and almost 0.5% and 5-year dividend growth rate of 13.3%. American Tower has increased their dividend for 11 consecutive years and counting. Analysts are looking for 2023 AFFO of $9.74 per share, which equates to an AFFO multiple of 18.9 times. For comparable purposes, over the past 5 years, shares of AMT have traded at an average multiple of 25.7 times, so a massive gap there in terms of valuation. Analysts have an average 12-month price target of nearly $230, implying that shares of AMT have 24% upside from current levels. There we just looked at 7 of my favorite REITs. All of these REITs have unique backgrounds, and all of these are well-run companies. But as you can see, with the rise in interest rates, they have faltered a bit here over the past 12 months. But that doesn't mean that they're going to continue to falter. It could also mean that it is a great buying opportunity, especially for long-term investors. And down in the comment section below, let me know which of these 7 is your favorite REIT. And if you haven't done so yet, smash that like button down below, subscribe to the channel, and we'll see you in the next video. Take care.